So the Federal Reserve had their meeting on Wednesday. I think this was only the second meeting of the new chairman, Kevin Warsh, and his credibility took a little bit of a hit. I saw one headline. It said Warsh didn't convey this message clearly or explicitly, and the bond market puked on him. That was a quote from John Hillenrath, a bond market trader. So, what does he mean by that? So, as we talk about frequently on the show, inflation is a concern. Inflation has been above the Federal Reserve's 2% target rate for close to 5 years now. And there's been various concerns about tariffs and oil prices and Iran and just general grocery prices, bird flu, eggs. You all know out there, prices have been going up on
Can't
all
eat
kinds
lettuce,
of stuff.
can't go to Taco Bell.
Yeah.
But you can drink tequila.
So, it's pretty widely expected that there's a good chance the Federal Reserve will very likely increase the federal funds rate in September at their next meeting. There was a few unique things that happened after this meeting. We had the first time that three. So there's a committee of 12 presidents of the Fed that meet and they vote on whether or not they should increase the rates or keep them the same or lower them. And it was the first time in quite a while since September of 2016 that three of the 12 dissented, meaning disagreed, with a unified directional view. So sometimes you get three people dissent, but they're not all in agreement. Like sometimes there's be one guy who says, hey, we should raise rates, another guy or girl that says we should lower them. And in this case, there was 3 out of the 12 thought they should have increased rates at this meeting.
So 9 said we're staying where we are, and 3 in unison said we should bump these up.
Exactly. And that was the first time since 2016, 10 years ago, that you've had 3 people in agreement that basically said that they should be doing something different. The other thing that's been happening since Kevin Warsh came on board as the new chairman is he's gotten rid of what they call forward guidance. So what that means is in the past, with some of the previous Fed chairs, they would, at the end of the meeting or in the press release afterwards, they would kind of say, okay, at our next meeting, we think we're very likely going to do this or that with regards to rates. And he's eliminated that. And so he's kind of lost some credibility because what happened in the bond market after the meeting, so they didn't raise rates. Inflation has not been great for the last couple months. And they didn't provide any forward guidance. So I think the bond market would have liked to see him say, we're going to increase rates in September. That's what they want, because increasing the rates is good for controlling inflation. And
but he would rather have and this is a quote from him, and I'll read it specifically, but he'd rather have the markets reading the data and not reading him. And his quote was, market participants are learning to play the ball, not the referee. And market prices will continue to respond in the direction and magnitude they see fit. This, in my view, this is Kevin Warsh's words, this, in my view, is a change for the better, and we're just getting started. So he's looking at it instead of people trying to read into what he's saying and make predictions based off of that, because this is all predictions at the end of the day, that if they just watch the trends and the data, that it will give a better picture than him standing up there. So I don't know. I mean, there's something to be said about that.
I mean, it seems logical when he says it that way, but I think the market reaction is pointing in a different direction. The market is saying that they want to see him be more take a stronger stance, right. I think is what the market's saying. So the 30-year Treasury yield, which is a really long-term bond, a lot of times we talk about the 10-year Treasury yield because that's pretty similarly follows the 30-year mortgages. So you have all these different Treasury bonds, which are basically like government IOUs. Now, the federal funds rate is really a short-term rate. So when we say the Federal Reserve is cutting rates or raising rates, that's not the 30-year mortgage rate at all. In fact, it's very, very common that mortgage rates go in a different direction than what the Federal Reserve does. Like I remember back like in 2009, they were cutting rates,
Mhm.
and people thought, oh, the mortgage rates must have gone down. I just heard on the news the Fed cut rates yesterday. And a lot of times it would go in the opposite direction. Like the Fed would cut rates and then mortgage rates would go up. Because a lot of times when Fed cuts the rates, that stimulates the stock market. Investors are like, okay, money's going to be cheaper. The economy's going to do well. Let's invest in stocks, which is not good for mortgages. And the opposite can also happen too. So when the Federal Reserve raises rates, and I think this could actually happen in September. I think there's a good chance that the Fed will meet, they'll raise rates in September, and mortgage rates the next day could actually be lower. I think it'd be possibly even more likely that they would go down. Because the investors that buy mortgages and the investors that buy 10-year treasury bonds and investors that buy 30-year treasury bonds, what are they concerned about? They're concerned about, what is inflation going to be in the long term? Because if you think about it, if you're buying a 30-year treasury bond, you are locking up that money for
Right.
30
30
years.
years.
And so we just don't know what inflation is going to be. You have this kind of looming situation with the, government's federal budget. And it seems like kind of neither the Republicans or the Democrats want to really take real action to control the increasing federal debt. So that is kind of a can that we continue to kick down the road. So when you're talking about buying a 30-year treasury bond, if you're that investor, you're asking yourself, well, what kind of condition is the US government going to be in to repay their debt 30 years from now? And what is inflation going to be like 10, 20, 30 years from now? And so then, they're looking at, well, who's in charge of the Federal Reserve and what's his stance going to be? And Kevin Warsh is people don't know how to read this guy, I
Right.
think, because, he was appointed by Trump, and Trump was pretty vocal back in like January and February that he wanted the Fed to cut rates. It's good for the economy and things like that when it kind of stimulates the economy when they cut rates, which if you're sitting in the White House is,
Good. Good news.
good
Right.
news if the economy is doing well. So, and I'm not trying to get like political, like generally it doesn't matter if you're a Republican or Democrat, if you're like, it's in the politicians' interest in the short term to have a strong economy, which is like cutting rates, but it's not good for the economy long term because if you cut rates when you shouldn't, it can create inflation. And so,
Well, let me ask you a question then, because
yeah,
you mentioned that there's a lot of people pushing for a rate cut, right? Um, and we're also heading into midterms this fall. So, how much of that do you think is tied into it? And again, this is just an opinion, right? Or not like we're not politicians; we don't study this stuff. It's just more. Do you think more people are being prone to trying to cut it so that it shows that they were proactive in that as they head into these midterm elections, which everyone is talking about how important they're going to be on both sides?
well, the Federal Reserve is supposed to be independent. They're supposed to do. His Kevin Warsh's job is to minimize inflation and maximize employment.
Right.
That's the dual mandate that was given to the Federal Reserve in the 1970s under the dual mandate regulations and laws that were passed. So his job is really to take care of inflation and employment, and not really supposed to be influenced by whoever's in the White House. And he's not supposed to be influenced.
Oh no, I know he's not, but there's other people like the other presidents, right? The other 12 presidents.
Right. Well, that's true
Yeah.
also. So, there is some political pressure to maybe cut rates. At least there was earlier in the year. Things have really shifted quite a bit since January and February. Like
Mhm.
I remember talking to people back in January and February, and everybody was saying at that time, and this was like pretty much widely in the news too, when you just looked at like expectations for Federal Reserve rate cuts, was here's this guy coming Warsh. He's kind of a little bit more pro rate cut. Part of the reason he was selected is he's more likely to cut rates than some of the other people. So he was kind of selected under that premise that he's going to be pro rate cut. And then he comes into office at a time where inflation's not getting better. We now have this war in Iran and increasing oil prices, increasing inflationary pressures. So you have the market forces are saying, hey, inflation is not getting better. Something needs to be done. And he said, in his I don't know if it was the press meet at some point after his first meeting, he said they were going to be vigilant in doing what needed to be done to get inflation under control. And I think he had some comments about that again. But the market, the people that all these folks that buy these bonds and mortgages, they really want to kind of see him take a stronger stance. And so the 30-year treasury yield jumped to the highest level in 19 years right after the meeting, the highest it's been since 2007. And that's kind of the market saying, we don't have high confidence that he's going to do what needs to get done to get inflation under control. And so maybe he will. I mean, I think if I had to put money on it, I guess that they will probably raise rates in September. And that could be good for mortgages. The fact that mortgage rates actually got worse by them not raising rates because it created concerns that they're not going to do what they need to do to get inflation under control. I think it's very likely they will increase the rates in September. And I think that actually probably is not bad for mortgages. So when you hear in September that the Fed increased rates, that does not mean that mortgage rates are necessarily worse. And in fact, if they do nothing and inflation continues to get worse, that would be worse for mortgage rates than them cutting rates.
Just an interesting take, and I'll get it in quick here before we hit the break, but it could also be a really strategic move because he is cognizant that we do have this war going on, and obviously the energy prices are driving up inflation significantly. So maybe a little bit of patience to watch and see, because if the war goes away and oil prices come back down and everything kind of settles back to what we were considering normal-ish, that may also have a big effect on it as well. So
true.
It's a really interesting time, and obviously we're going to continue to watch it. We've got the summer break now, but when they meet in September, we're going to have a lot of information and some new economic reports.